Hi, and welcome to Momentum's coverage of arguably the most important budget since the national election of 1994. I would like to take this opportunity to welcome each and every one of you for your time. We realize that there are many providers that is covering the budget, and you decided to spend time with us. Thank you for that. I would like to take the opportunity to introduce my esteemed colleagues. Mike, welcome. Mike is the Chief Investment Officer for Momentum Investments. Sanisha, economist at Momentum Investments. I'm glad that you found the time to attend Momentum's budget. While I was researching the budget event and kind of what's transpired, you were on the internet. When I switched on the radio, you were on the radio, and so I'm happy that you are here with us today.
It was a busy day.
I can imagine.
Always is.
Budget. So this year round, I thought it'd be a good idea to do things slightly different. And so having watched many of the budgets, I think it's imperative that we don't just focus on the numbers, but we ask ourselves the critical question: what does the budget mean for our viewers? What does it mean for the person on the street? And so today I want us to really focus on bringing it back home. And so, I'm excited. I have pulled out a few themes ready for discussion, and I look forward to discussing these themes with you. Before we start, it is important to realize that the budget itself cannot be seen in isolation. The budget itself operates within South Africa, and I wanted to start off by, Mike, maybe you first. Maybe you can give us just a 2-minute overview of where does South Africa find itself?
So South Africa's in a very tight spot at the moment. We've got trend growth that is below the population growth, and as we go into the future and as we've gone over the last couple of years, systematically the man on the street has become poorer and poorer in a context of a more competitive global environment. So we are losing our way relative to the rest of the world, and we're becoming a less attractive investment destination for a lot of foreigners. So we're in a gentle decline, and it's imperative that for economic growth into the longer term, we need to arrest that and turn that around so we can start getting real growth above population growth, become a more attractive destination for investment, because ultimately the only thing that saves the country in the long run as an open economy is growth and foreign investment. And we need to make ourselves an attractive investment destination to bring foreigners into the economy. We are just not big enough. We are not a USA, we're not a Brazil or a China where you've got a home market that's big enough to sustain economic growth. We are part of a bigger world, and we need to realize it and need to make ourselves attractive to that world.
Thanks, Mike. I look forward to seeing whether the budget of this year was able to at least solve for some of those challenges that you've referred to. Sanisha, you've got 2 minutes.
I would say that South Africa is a laggard. We've underperformed our emerging market peers. We are significantly below the growth rate in EMs over the last 10 years. South Africa, on a real per capita basis, which is really looking at whether people got richer or poorer over the last decade, we're down about 0.5% over the last decade on average per year. If you compare that to the average emerging market, they've grown at about 2.5% per annum on a per capita basis, and the average developed market at about 1.5% per annum. So as you can see, we've lost quite a bit of ground. And as a result of that, as Mike pointed out, there are more people that have now been pushed to the brink and pushed into poverty. Unemployment is not solving for the number of people that are getting into the labor market. And as a result, the South African economy is just not growing fast enough to get people to improve their standard of living.
You touched on unemployment. Unemployment figures came out day before yesterday. I guess an important point in that, youth inflation is now over 60%. So it speaks to almost, this problem that we are facing. How do we get the younger and younger people that finish university, finish their econs, how do we get them employed? In each and every almost review of a budget, the most important question asked is the following. What is your rating of yesterday's budget? And so I'll start with you, and I want to all throw in an extra thing in there. So tell me what your rating is for the budget out of 10. Happy to go into 0.5 percentage points. And then summarize the budget for me in one word.
Okay. Francois, for me, the budget was a 5.5. And if I should, it was a tough budget in a tough environment. So I think there was decent work in that budget, but it's not solving things sustainably. So if you ask me what word would I use to describe the budget, I'd say treading water.
Treading water. Is that one or two words?
It's a hyphenated word.
Hyphenated. I'll accept it. Sanisha.
Francois, I think I'd give the budget a 6.5, and it's slightly better than Mike's rating because I am taking into account the political and economic context that we are operating in. And my word is rabbit. Think about a white fluffy rabbit. I think in the last couple of years, we've seen government pull out a couple of rabbits out of the hat to try and stick to the fiscal consolidation path, to ensure that we are still on the debt stabilization path. But I think if we start peeking into the hat, we're not going to find many more rabbits left.
Yeah, that arm's pretty deep into the hat already.
And so it is. And so we've got a 5.5, and we've got a 6.5, and a rabbit. Let's see how we can unpack those two ratings as we progress through today. Sanisha, I want to actually make a link to something you said, not the rabbit necessarily, but the debt point. And so the first thing that I do want to touch on is debt, and maybe a question to you. While I was almost going through what was said yesterday, the numbers are massive when we look at debt. Some numbers here. Gross debt to GDP ratio is the highest that it's been since the Second World War. I mean, those numbers has got to be worrying. I also see a trend. You look at the numbers now, which is supposed to peak at 75%. What worries me is last year, during the budget, it was said that we would peak at 70% and make our way gradually over the next few years towards 60%. Now, you can argue 5% is not a lot, but I mean, if you just lift the conversation and you almost identify what that 5% means, I mean, shocking numbers is the government will pay 1 billion rand a day towards covering debt. In about 3 and 4 years, that number is going to increase to 1.2 billion. Those numbers for me, those numbers for anybody watching this, has got to be alarming. And then, maybe just to finish that, the more alarming part for me is that servicing debt, 20% of revenue goes towards servicing debt. Sanisha, are you worried at all about those big numbers, or are they just big numbers?
I think that there's two things to be worried about. First is the level of debt, but even more worryingly is how quickly we got there. So if you look at the difference between where we are today and where we were during the global financial crisis, South Africa had the biggest, I would say, debt explosion relative to any other emerging markets. And because our debt pile has grown, we've seen that the debt servicing costs on that debt pile have also grown. And so relative to other emerging markets, that 20 cents out of every rand of revenue we collect going into servicing our debt is again one of the highest from that emerging market spectrum if we look at the change that we've seen since the global financial crisis. And I know those numbers are quite big, and it's quite difficult to grapple with the billions and trillions. So the way I look at it is to say, how much debt does each person in South Africa actually carry? And
what is that number?
that's actually now sitting at 82,711 Rand per person. That
Leaving out the cents, I see.
Leaving out some cents and including all the
Yeah.
children and elderly, so every citizen in South Africa. And so that's, you know, a number that's a bit more tangible, I think, for us to really
Makes it
grapple
real.
with. It makes it
And
real.
arguably, so, I mean, economists, I mean, you are concerned about this number, not just the size of it, but how quickly we got there. What would you say is the main reason for almost this exponential rise in debt? Is there a few factors that you could contribute that to?
I think there's a couple of factors that got us there. And it also can be twofold. So if you're looking at the debt ratio, remember, then you're also looking at it relative to growth, which is your denominator in that formula. And the denominator, economic growth, hasn't been performing that well either. So it's actually okay to have, you know, a Rand, a billion, trillion amount of debt that's quite large, as long as your economy can actually support that. But we're in a situation where the economy has been quite stagnant, unfortunately, and we haven't actually been able to bring that level or that ratio down over time.
And
Mike?
the other component is the debt servicing cost. So pre-GFC, the yield that you're paying on government debt was a lot lower. And one of the big drivers of the explosion of debt has just been the incremental increase in interest servicing costs, where I think 2008 it was around 13, 14 cents per Rand. Now it's at 21%. So it's a massive crowding out effect. And what you always need to remember with debt is it's a long-term perspective. You know, it's not like personal debt, it's perpetual debt. Countries are around forever, so they can sustain high levels of debt. The big question is the growth of debt slower or faster than the growth of the economy and the revenue ultimately being collected by the tax authorities? And one of our big problems is that the growth of debt, including the interest payments, has been faster than the growth of the economy. If it was the other way around, it would have resulted in debt stabilization. And generally, you know, the emerging markets, global markets want emerging markets to have much lower levels of debt. Developed markets tend to carry much higher levels of debt. It's got something to do with the interest rates that play into it. South Africa is nicely in between. You know, the developed markets tend to have well over 100% debt to GDP, but they're paying much lower interest rates and they're getting growth that's exceeding
Natural
that growth.
consequence of South Africa is the higher interest rates,
100%.
higher debt servicing cost.
And we need that to attract the foreign investment.
But then that leads actually quite nicely into the next point.
Mm-hmm.
The momentum economists are saying the debt to GDP is worrying.
Mm-hmm.
And so from a foreign investment, if you put yourself in the shoes of a foreign multinational,
Mm-hmm.
does this high debt to GDP ratio concern you whatsoever? And please give a view on both equities and on bonds.
So it definitely worries you. So if you're a foreign investor, there's a couple of decisions you need to make. You need to say, do I invest in South African debt? Do I invest in Mexican debt? Do I invest in Turkish debt? Do I invest in Brazilian debt? And then it really becomes a question of what is the real rate of growth I'm getting, and for South Africa to attract that, the real interest rates that we're paying is quite high. And the second factor that a foreign investor is really circumspect about is currency and currency depreciation. And South Africa has a very volatile currency. So on both of those metrics, South Africa can be a risky investment proposition, especially if you're looking at one of the nearer broads for a US investor. You know, he'll be looking at Mexico, Brazil, it's closer, makes a little bit more sense. I mean, Turkey has been in a little bit of a basket case. So there's a lot of things that come into it. So our debt levels and our interest levels are high for a reason. And there's country risk, there's inflation, there's the need to attract foreign investment. I mean, from an attractiveness perspective, the budget yesterday was actually quite positive for bonds. And the reason for that, there's a term they call the primary budget surplus, but essentially that means is if you strip out the interest payments, are we bringing in more money than we're spending? And we are. The problem is our interest payments are massive, and that takes us well over that. So the bond markets like it, and the bond market also like that optically at least the debt stabilized, or the levels of debt sort of moderated a little bit. So it was positive for the fixed interest markets. And we can talk about it later, but the South African government is banking big time on a reduction in interest rates and sovereign, the need to pay up for sovereign debt is the one component. So I think for fixed interest, for bonds in particular, it was a positive budget. For equities, for South African equities, there's a lot of headwinds for the South African consumer, which means there's not a lot of disposable income. So for South African equities that have got a huge reliance on the South African consumer, it's not a good budget. But then again, the South African Stock Exchange, about 70% of the revenue earned by South African equities comes from offshore, and it's going to be far more a consequence of what happens in global growth, what happens with global inflation and interest rates. So a component of the equity market is going to have some headwinds. The big thing to watch out for is interest rates. If we get inflation moderating and interest rates starting to roll over, there'll be more money in the pockets of consumer, and that will be additive to, or that would boost the equity market. So that's really, it's a delaying game. And if you ask me about kicking the can down the road, if you ask me about this budget is a delaying game, hoping for things to get better in the future. Almost
tying back to something I can now almost see in front of me as a rabbit.
Mm-hmm.
It seems that when it comes to debt, that Treasury has found a rabbit. 2 weeks ago, if we talked about abbreviations,
mm-hmm.
Probably the most complex one that came to mind was potentially GDP, NHI. But the rabbit these days have got a name, and the rabbit is called GFECRA. I have to actually just look on my tablet. It's a Golden Foreign Exchange Contingency Reserve Account. Arguably the most complicated abbreviation ever used in the budget. Sanisha, you've got to tell us what this is. What is this rabbit? Tell us all about it. 2 weeks ago, though, I think it is important to note, I don't think anybody was saying anything about GFECRA.
It was only really late in last year when even the economist circles started to know a little bit more about this rabbit. And I do think that there was quite a lot of political pressure to tackle the GFECRA account. Now, the GFECRA account in itself is just your gains or losses that you make on your foreign exchange reserve. So it's quite important to note that it can be gains or losses. This is, we do have a freely floating exchange rate. It's not a one-way bet. And so, we could find ourselves in a scenario where the rand strengthens and those assumed gains in the account actually come off. And so given that the rand has depreciated against the dollar over the last couple of years, we've seen that these unrealized gains have grown in the GFECRA. And
sorry to interrupt, but you speak of grown. I mean, if I read the GFECRA account was 35 billion big in 2002. And so what this really relates to is almost this weakening currency that South Africa has gone to.
Precisely. It's the weakening of the currency that has led to these unrealized gains. But I think that pressure's come that, we need to tap on this rabbit because we are now running out of other funding options. And so by tapping the GFECRA, we've now got another revenue stream that we've brought in. And I think government really hopes that by using GFECRA to effectively bring down the debt ratio over the next couple of years, to see that stabilization taking place, will then reduce the sovereign risk premium. And by doing that, we bring back confidence into the market and we improve the appetite for domestic assets. And so it is a little bit of a hope strategy. Now, that GFECRA at the moment is sitting at 506 billion. That was the last recorded number for January.
That's an amount.
That's an amount. And we need to take note, however, as I said, the currency is not a one-way bet in South Africa. We've got a freely floating exchange rate, which is one of our rating strengths. But that means that we need to have a buffer in the account to account for potential strengthening in the rand. And so National Treasury have said that the implied buffer right now is sitting at about 256 billion. So 150 billion will be used over a 3-year period. Then they're also giving the Reserve Bank 100 billion. Now
so
remember...
What will the 150 billion be used for?
So now this is effectively going to bring down your debt levels over time.
Okay.
And that's really the strategy. How it's been done, remember, if we didn't have this taking place, the debt ratio probably would have ticked a bit higher. And the debt ratio is ticking a bit higher because we've had a wage bill overrun. Effectively, we are using the JFECRA funds to cover that overrun in the wage bill. And for me, that's not really a positive from the budget because, the wage bill is a recurrent expenditure. And the JFECRA account, once you've tapped it, it can run dry. And it is a bit of a tricky one to use because if the rand strengthens, it means that buffer, that 256 billion, might actually have to be bigger. And it means that we can't tap on it forever.
So has Treasury found the fountain of youth, the eternal fountain of youth? I mean, it would seem that way. I mean, you are referring to 506 billion. I mean, these are rather large numbers. 150 billion to be used for paying off debt, which in our previous theme, we said that it is a problem. And so I just want to really ask two things. I mean, is it this eternal fountain of youth, and is it well understood how the JFECRA account works?
So eternal would not be a great word to use here because I do think it is a bit temporary in nature. Once we've used the account, you won't be able to tap on it again unless you get more unrealized profits that are then generated by a weakening currency. But by the very nature of trying to bring down the debt ratio and try to reduce the sovereign risk premium and increase confidence, that would then be paired with a stronger currency over time, one would hope. And that means that some of those gains in the account would be eroded naturally by a strengthening in the currency.
So the natural question that comes up for me is we've got the rabbit, it represents 150 billion. Do you think a lot of consideration was given to what we will spend the 150 billion on? I mean, as I said here, another pressing issue, which we'll get to, is, corporates getting anything out of South Africa. And so, was Transnet not an option? Do you think further thought was given to how we can effectively use the 150 billion? And how does that weigh up against, what it's currently being used for?
Now, this has been something that's been a challenge in the budget for a number of years. It's that balance between recurrent expenditure, which is largely your wage bill or social grants, versus capital expenditure. Capital expenditure, by its very nature, has what we call a higher fiscal multiplier. For every rand that government is spending, you actually get more bang for your buck if you spend it on capital rather than going to spend it on the social grant or on the wage bill for civil servants. And I think that was a trick that government missed this time around because those JFECRA funds could, in effect, have been allocated to, let's say, a Transnet, which we know has been one of the sticking points keeping, a lid on growth in the South African economy. So I think that was a bit of a trick that they did miss in the budget. And unfortunately, we've also seen that capital expenditure has been pared back slightly in this budget. And that's not really a trend that we want to see. I mean, Treasury alluded to in the budget last year that trend growth in South Africa is sitting just slightly above 2%. But unlocking further capital expenditure can actually boost trend growth, and it can resolve a lot of the problems we spoke about at the beginning of this session in terms of trying to generate more jobs.
So I think I'm going to be that person to ask the following question. Is there enough controls in place so that this 500 billion, or the buffer that you refer to, is adequately controlled? What is the risk that this almost once-off windfall is misused?
I think the risk is high. I would say also going into this, generally speaking, when a new funding stream comes about, there's quite a lot of consultation with market participants in National Treasury. And so going into this year's budget, I think, there were a lot of questions from the international investors about JFECRA and what it can be used for and how much can be tapped. The local investors acknowledged that it was a potential source of funding for government to use, but there hadn't been a very, long discussion about JFECRA before, no real consultation. And so for most of the economists and, investors out there, the first time we really saw the detail was essentially in the budget itself. Treasury has set out a couple of guidelines, but they are quite broad. And I think, there's quite a lot of nitty-gritty in that detail that hasn't yet been decided upon. And I think this is making the market a little bit nervous. So initially, and Mike also alluded to this, the fixed income markets, they liked the outcome of the debt stabilization profile. They liked the outcome that the deficit ratio didn't change all that much. And that was very similar in the currency markets. But by the end of yesterday, at around 6 o'clock, we saw that a lot of those gains in the currency market were actually reversed.
Yep.
And I think this is the market now starting to read through the detail of the budget and realizing that those JAFECRA funds could have potentially been used in a better manner.
And arguably, South Africa doesn't have the best record of not misappropriating funds. And so, I guess, just to maybe conclude, it is slightly alarming that there wasn't broader consultation, within South Africa, especially when it comes to almost such a strategic reserve as JAFECRA.
But the point I'd like to make is I think it gives you an indication of how tough the budget was for the finance minister, how under revenue pressure he is. And essentially what they did is the coffers are running empty, and they found a piggy bank at the back of the cupboard, and they started to dip into that piggy bank, and it's not a very big piggy bank, so it's 506 billion at the moment, but for every 2 rand strengthening in the rand, it essentially wipes out about 100 billion of that JAFECRA account. So there's not a lot of good news that has to come into the system, in which case the government or National Treasury will have to start finding money to start topping up the piggy bank that they've been raiding.
So we've spoken about very high debt, Sanisha's point on, the rabbit. What we need is growth. And that really brings us to my next theme, and that is to say, Mike, can we grow ourselves out of this situation? Let's use a period of 5 years at 3.5% growth. I mean, maybe just for comparison, in the budget yesterday, growth was assumed to average for the next 3 at 1.6%, which, according to most economists, is almost unbelievably high in terms of what we've achieved the decade before. And so my question to you is, can we grow ourselves out of this for the next 5 years if we assume a growth rate double what is assumed at the moment and 3 times more than what the IMF is saying we'll grow at?
So you've got to contextualize it in the context of what is the population growth rate, and our population growth rate is 2%. So real growth of 1.6% means that on a per capita basis, we're going backwards. So you need 2% growth to actually just stay in the same place. Anything above that, you can start addressing the issues. So on a 5-year basis, there's absolutely nothing we can do to arrest the situation where we're in. So we need to start taking much longer term views in terms of what are the policies and capital expenditure that we need to take now that will, in the next generation, put South Africa in a significantly better situation. Unfortunately, that is not a politically popular view to take. So we're in this catch-22 situation. South Africa, the only way we get out of the current situation is long-term growth that is significantly above where we are at the moment. But even significantly above where we are at the moment is not going to be enough. And we're going to have to navigate a pathway of social instability, a lack of social cohesion, splinter parties on the fringes. So South Africa is going to be a very exciting political environment and a very difficult environment for a long time. But what we need above all else is growth. We need capital expenditure to get that growth. We need a ceiling on expenditure, which the government is trying desperately to do, but battling, and we need it for a very long time. We're 30 years into our democracy. We probably need to be realistic and think about 30-year projections into the future rather than 5-year government terms, because nothing anybody can do, even if there's a brand new government tomorrow, nothing they can do will be able to arrest it on that horizon.
And what I found interesting from the budget was that there was no real update on longer term growth assumptions. Do you think it's just because it is almost unrealistic to try and forecast that far ahead? Or do you think we are in the trenches right now trying to fix the situation that we're in? Sanisha?
I think we're finally in the trenches understanding what the problem is. And, many people are saying that Transnet today is where Eskom was 2 or 3 years ago. And so that means, Eskom, we realized the importance of electricity to generate economic growth. And we're now realizing the importance of the logistics space for economic growth. I think, it also has to do a lot with political willingness to allow the private sector to operate, in financial terms as well as technical expertise where government has operated for a long time already. There's quite a lot of legislation, particularly now in the transport space, that we're still waiting for in order to allow the private sector to operate some of that railway network. We're making some headway with the port situation, where one of the Durban ports, 50%, 49% of that port is likely to go to a private consortium. And with that, we are likely to see efficiencies being brought out once again. So I think we're in that situation where we realize what needs to be fixed. I think that government has finally cottoned on, and they said this in the budget, that we need massive investment from the private sector in order to generate a higher level of economic activity and to finally bring about a solution to the unemployment problem. So I think we've changed the psyche in government, and now we have to see that follow through, which again all boils down to political willingness.
If I take you back 10 years, do you think in that 10 years the government has realized the importance of corporate involvement, firstly? How do you think that has shaped over 10 years, firstly? And also, the picture that you paint is quite a bleak one, and that is to say, the government is realizing this is something they cannot fix by themselves. There needs to be a partnership between government and, some of the private entities.
So that you're alluding to is what government always refers to as the social compact. And since Ramaphosa has come into, as the president of the country, he has often told us about this concept of the social compact between, academics, labor, civil society, business, and government. And so I think what we have seen is a little bit of a trust deficit between business and government, especially in terms of backlogs in legislation being passed. Government will say we need more private sector participation, but then the timelines to actually get the private sector on board seems to be quite long. And so that's that gap between when policies are made versus when policies are actually realistically implemented.
And executed
upon in South Africa. And I think that there is this realization that we do need to get business on board. A few State of the Nation addresses ago, we had Cyril Ramaphosa saying that we really do rely on the private sector to generate jobs in this economy. Ultimately, government only makes up 20% of jobs in South Africa. So, what is government's role in that? It's really to develop an enabling circumstance for your private sector to get more involved, to build on their businesses, to generate a higher level of growth, to be able to hire more people in South Africa.
So this realization for me is an important one. But what I still find quite interesting is just this. Let's use Transnet for an example. A lot of talk in the market about public-private relationship that could potentially make a big difference in Transnet and getting it back on board. But every time you almost hear about these initiatives, we are talking about 5 to 7 years. And having a Transnet that doesn't operate at full capacity, full efficiency, for another 5 to 7 years feels like it is, an extremely long time to fix something that is arguably very important for growth and an enabler for growth. Mike?
But it talks to two sides. So the one side is around policy execution, the speed at which policy comes online. Another component of it is policy stability. So, can you take a 30-year view on policies and regulations and they don't change? Another big component of it is, as Sanisha alluded to, is the trust deficit between government and the private sector. And very often when I've been in interactions between private sector participants and government sector participants, they come to the same problem from very different angles. So government almost comes from a social perspective to say, this is infrastructure, it's for the benefit of the country, we need it, it's a social good. Whereas the private sector comes from it from a commercial perspective. To say, look, we've got capital, we've got investors behind us, we need a specific return on equity. And very often there's a big misalignment between the expectations from both parties, and it's not helped by the trust deficit. I mean, another big stumbling block to significant private sector investment in the infrastructure side is these are massive projects. No single company can support the development of a power station, or if we're looking at bulk, the Lesotho Highlands project, these are massive, systematically big projects that dwarf the size of a lot of companies. So, there's also, and there needs to be a way for multiple private sector participants to be co-funders together with government in terms of these big projects. And I mean, there is competing interests. There is a lack of trust in terms of what is going to happen with the funding, who manages and operates the projects. Are they on a purely commercial basis? A big concern for the private sector is political interference. So to what extent is there political interference and other parties that get involved in particular transactions? So what's clear to me is we need it. What's clear to me is that we also, from the private sector and the public sector, on very different pages in terms of what we want to try to achieve out of these projects and what our metrics are. And the only way we're going to get there is incrementally. Nothing's going to happen quickly. I mean, your question is, 5 to 7 years on the infrastructure on the railways. What does that mean? Well, I'll tell you what it means. Expect more potholes on roads as we just put more and more trucks. Yep. We're going to start seeing a couple of wins, hopefully. The Richards Bay coal terminal, the coal line up the KwaZulu-Natal coast. You've got the Saldanha, the steel line. When those lines become more and more operational and companies realize that they can start trusting, that they're going to put something on a train truck. It's not going to become one of the biggest train wrecks in history, which we've had a couple in South Africa. It's going to get to the port. When it gets to the port, it's going to get onto a ship. So you need the container companies to come on board as well, and the ports to operate efficiency. So it's a long-term perspective. We need some small wins. I don't think there's going to be suddenly a magic pull and massive big projects that are successful. So even when we look at infrastructure investment from our side, most of the infrastructure projects we look at is there's a big private sector component to the project. Where government really starts to come in is on offtake agreements. So you're generating electricity, how do you get it onto the grid and how you get it into the distribution network. So very much from the private sector, that's how we're thinking about these projects. But to really tackle the backlog of infrastructure, we need the projects to become bigger. Not much was said in the budget around infrastructure, apart from the need for some specific tailored investment vehicles that can crowd in some of the funding. So it was a little bit insipid and boring in terms of, but it's essential. But it's things that will take a long time to realize, to get to fruition. But we've got to go down this trajectory. The same way that Eskom, I think the load shedding guy was waiting for the president to finish his speech before he ramped it up to level 6 to prove that maybe it wasn't over as much as we think. But the Eskom situation, the load shedding situation, slowly is going to get better. Sometimes it doesn't feel that way, but there's significant investment and things that are happening in the background. And when you're on the back foot, it takes a while to get forward. So Eskom will improve. Power more and more will be privatized. Transmission potentially will go that route as well. We in infancy, we're at the baby steps with the logistics and railways. So it is going to take a little bit of time to get there. What we do need is certainty, policy certainty, and what we do need is that, government sticks this course for a long period of time. That's the only way we get out of these situations.
What it does show clearly is still the importance of state-owned enterprises.
Mm-hmm.
And look, your point on Eskom is a valid one. I think, maybe if you're being negative, which I'm certainly not, you could argue that a lot of damage has been done already. And you look at the growth rates. I guess, I'll touch on state-owned enterprises a little later, but, you've got to ask yourself, if we had functioning state-owned enterprises, what would that growth rate have been? And so maybe pause that as I want to just touch on revenue and taxes. You cannot have a budget without touching on either one of those. It was surprising to see no new taxes. There was quite a lot of speak on, whether that would be increased. There was some speak of other types of taxes, but it is interesting to note that there were no new taxes that was involved, and it almost brings me to this point, Sanisha, and maybe a question for you, and that's to say, before you start thinking almost of introducing new taxes, how do you almost balance that against being more effective in how you collect tax? Compliance. How do you use technology, modernization, artificial intelligence, if you like? How does those two things interact?
I think they interact via what we call the Laffer curve, which is essentially, raising the tax rate and how much revenue you can collect from that. Now, we're at the point on that curve that if you have to start increasing the rates of personal income taxes significantly higher than where they are right now, your total overall revenue that you collect might actually even be less, because people start to then either, evade tax or find clever ways of not paying it. And so I think, there is a realization on the part of Treasury that we are perhaps on that side of the curve right now. And in a constrained growth economy, we should be tackling things like tax administration, closing the loopholes. And by closing the loopholes, I think we saw this coming through in terms of this global multinational company tax. And that's really to ensure that the multinationals are also paying a tax rate and not really, slipping through the cracks. And that is expected to garner almost 8 billion by the outer year of the medium-term framework, which is essentially when they're going to implement this tax. And so I think it's this is where we are right now, sitting with, quite a constrained economic growth profile, very strapped consumers, and we really are at that juncture now where we need to look for other avenues to start collecting taxes other than just tapping your personal income tax rates, your corporate income tax rates, which will probably start going the other way in terms of actually being lower over the next couple of years in order to attract inward investment. On value-added taxes, I think there is still a place for us to increase VAT. Obviously, it was very difficult to do that in an election year. But at 15%, we are sort of middle of the range when we look at our global comparative. So there are other markets, including emerging markets, that do have, a tax on goods that's a little bit higher than ours. But I think that government is potentially keeping their powder dry on the VAT rate. We've got some big ticket items that might be coming along the way. If, national health insurance does come to fruition, even though there was an additional allocation for an extension of the social relief of distress grant for another 2 years beyond March 2025, there is still no permanent funding solution to extend that grant into perpetuity. And so I think, considering the value-added tax rate might be something that Treasury could tap further down the line. I think they possibly get around that by just increasing the number of items that have a zero-rated VAT implication, just in order to protect the more vulnerable of society. Because after all, we know that VAT is a regressive tax rate, unlike personal income tax, which is more progressive, hurts the rich more than it does the poor.
So when I read the budget speech and the documentation, what struck me about the approach of SARS and National Treasury was how absolutely conservative they were. So even the JAFECRA approach, they consulted extensively globally to look at what best practice around the world was, and tapping into those reserve or that contingency reserve was not unusual. Even the 15% corporate tax on multinationals is aligned to the OECD objective to try and stamp out tax arbitrage between jurisdictions. So it's fully in line with global best practice in terms of not getting Facebook to set up an office or Apple to set up an office in Ireland.
For tax purposes.
For tax purposes. So all the new tax initiatives, all the new funding mechanisms, it was a very cautious approach. Nothing was done that was wildly populist or out of line with what you'd expect from a global best practice perspective. So I think National Treasury had to walk a very delicate line in terms of trying to fill the coffers a little bit, but not scare the taxpaying population.
And would you say you use these words, not scare? Maybe that's why there was some reprieve as well. RAF, fuel levy, those have now not been increased for, I think, 2 or 3 of the last budgets. And if we speak about personal income tax, maybe just a question to you, Sanisha, are you surprised about, given themes that play out and that everybody is aware of, immigration, you refer to cost of living, unemployment. Are you almost surprised about how robust collections in personal income tax has been when you compare it to corporate tax, for example?
100%. So, if we look at the run rate of the various tax components, it's mostly your corporate income tax that will underperform relative to your full fiscal year. And that's because we've had weaker than expected commodity prices and your mining tax revenues. Transnet has taken away from the logistics side, so your manufacturing component has also been hit there. We've also seen softer growth out of the VAT intake, but some of that is due to VAT refunds. And then, of course, we've had an upside surprise coming through for your fuel levies and for personal income taxes. Now, on the personal income taxes, I think by and large it's been because we actually had quite a strong performance in nominal wage growth. So after the pandemic had hit, we saw quite a quick jobs recovery that happened in the skilled sectors of the economy. And a lot of data from some of the commercial banks showed that the wage increases, particularly in your financial services sector, was actually supporting consumer spending quite a bit. So I think that's really what's helped, other than things like what we want to see is real, obviously, employment coming through and real wage gains. But it's really been on your nominal side of things that the nominal wage gains have been quite strong, and that has then fed through into higher than expected personal income taxes.
And don't forget it's an election year.
No.
So, government's got to be very cautious about hitting people in the pocket, and the consumer is constrained. So literally you can...
So 2 things, Mike, and I have to interrupt you there. And I would like both of your opinions on this. So let's quickly touch on the election. I'll ask both of you the same question. Is the ANC, the ruling party, are they happy with the budget that was given? First question. Secondly, you speak of, and I've heard this now from both of you, this consumer that is under stress. Remember, that consumer that's under stress will now move within the personal income tax brackets because those weren't adjusted for tax, and so that means obviously he's going to pay more tax, the consumer. What effect will both of those have? So please touch on both of those.
Sure. So the bracket creep that you're referring to, in other words, your tax bracket's not adjusting by inflation like your income does, really does hurt the consumer. Studies in the past have shown it's actually your middle income consumer that gets hit the most. And it's almost what we call like a tax by stealth, because if you had a personal income tax increase or a VAT increase, it hits the headlines of newspapers quite differently than to talk about bracket creep. And so what you find is that over the last, I would say, since the global financial crisis, there's been this mild erosion of real wage gains by the end consumer, particularly in your middle income classes, because of stuff like your bracket creep really coming through. In terms of the election and how that plays out in the budget, so a lot of people ask, was this a populist budget? There's a nice measure that you can look at to tell you whether how redistributive the budget is, and that's really looking at how much of the budget expenditure went to things like health and education and other amenities, and it's sitting at about 60%. So that's been quite, similar to what we've had in the past, where 60% of expenditure is essentially going back into services to ordinary South Africans. We did see that they tried to cater for some sort of extension of the social relief of distress grants. So in November last year, they said it would be extended to March of next year. Everyone was quite worried, given that this is not something that is easily, pulled away once you've granted it. And so they've put in a provisional allocation for another 2 years. I think what would have been more populist in nature was to give a bigger allocation to something like a national health insurance, which didn't really come through.
But Sanisha, just to pause there, you can't ignore the fact that there's 30 million people on grants.
And a small and shrinking tax base. Mm-hmm. So again, you need to ask the question about how do we make the system more sustainable? And unfortunately, in South Africa, the grant system is not conditional. It's not conditional on education outcomes for, the child grant as an example. And, there have been studies by the International Monetary Fund saying that the grant system, in some ways, actually lowers the employment prospects of certain portions of the population, particularly the more uneducated, because now you've got your grant and it actually reduces your prospects of looking for jobs. And so we need to be quite careful in how the social grants are doled out. In my view, I think they should be largely conditional. So at some point you can actually say that the economy has recovered on the back of these. We have actually reduced inequality in a more sustainable fashion. And we can have an outcome where we don't have to be spending close to 4% of GDP on social grants.
And that is a number, 4%. I do have to take you back to the ANC. Is the ANC happy with the budget? Do they look at this budget with admiration and with pride?
I don't think that this was a populist budget. I think that they really did try to toe the line in terms of maintaining this approach of fiscal prudence. And it was a very challenging backdrop to do that in. We've got slowing growth. We've got rising social demands. And so I think they tried to toe the line quite carefully.
Mike?
So the one word that comes to my mind when I look at the budget is optics. So if you look at the lack of creep in the income tax brackets, at the end of next month, you're going to get the same salary in the bank account. And if you remember, every time there's a little bit of a bracket creep, you get a couple of R100 extra in your bank account. You feel good about it. So optically, it will feel that you're not making less money. So optics was quite important.
It's such an interesting point that you're making.
So the dilution was in real terms. If you look at some of the expenditure items around healthcare, basic education, there were increases. So optically, the numbers got bigger. But relative to inflation, they were sub-inflationary. So you had a very optical budget that seemed to push on things like the social wage, that seemed to not take money out of the pocket in nominal terms. But in real terms, it did. And that talks to Treasury trying to walk a tightrope of fiscal discipline. So I think that's an important theme that came for me through in the budget. Do I think the ANC was happy with this budget? Not at all. I think they would have liked to have more certainty in terms of what happens with NHI. NHI, 1.4 billion rand. It's pretty much nothing. They're going to spend it on some better record keeping and pilot projects. In essence, they're saying it's still there. We're kicking the can down the road. Why are we kicking the can down the road? We can't afford it. We're not going to dare go near VAT, which is the most efficient mechanism for getting the money we need on the one side. On the other side, the public health service is in a shambles. I mean, if you want all the doctors to emigrate, you go too fast in that direction. So I think from a populist perspective, there was attempts to make things look better, But in real terms,
Optically.
optically, it looks better. In real terms, a lot of those retirement fund reform, two-pot, okay, that's coming. NHI would have not been where the ANC members on the councillors on the ground trying to get people to the polls. They wouldn't have been able to land the message that this government is looking after you.
But
Well,
let's
it's
speak.
not.
There's a few smaller themes that I want to touch on, and maybe it's good to speak about NHI. I mean, some headline figures, and they are vast and broad, says that NHI would cost between 300 and 800 billion. My question is, you spoke of the 1.4 billion committed. It feels almost insignificant. And then I want you specifically to comment on this. What I don't understand is there is an importance of NHI being driven. We are waiting for Ramaphosa to sign it into law. We know we can't afford it. What I find interesting is that real health expenditure is negative, or at least is projected to be negative for the next 3 years. How do you reconcile those two things? The clear importance of NHI, President's waiting, against this almost expenditure that's on a real terms negative over 3 years.
I think this goes exactly to Mike's point on, the optics of it. So there's a lot being spoken about NHI. There was, the NHI grant and further allocations. But when you look at health expenditure, it is declining by around 1.5% in real, so inflation-adjusted terms per year for the next 3 years, which is in the medium-term framework, which then really shows you, how government is thinking about health spending in the context of its total expenditure budget. And as a result of that, we know that there are, major flaws with the NHI in its proposed fashion, in terms of not having the adequate skills to fulfill the NHI plan like they wanted to roll out. And I think a lot of that still needs to be tackled. I think we also need to remember that NHI will be rolled out in phases. So, there is a potential for NHI to come out in a way where we can potentially achieve something out of phase one, but it takes a lot longer, rather than thinking about it in, one sort of wholesome view, which at this point in time doesn't seem like we've got the funding or the skills to adequately fulfill that dream of NHI.
Mike, you touched on two-pot from an investments perspective. Look, not a lot was said on two-pot, which was fairly interesting. I mean, but from a pure investments perspective, giving people early access to retirement money, are you concerned about what it means for the longer term? How do you weigh up this immediate need to get access to capital, which many people do, against the concepts that everybody know and love, and that is to say, time in the market, staying invested. It seems almost contradictory, and whether we are not creating a much serious problem down the line. Your views?
I think there's a time frame perspective on this. There's the short-term view and the longer-term view. So the longer-term view is that you need a more permanent capital vehicle, or a more permanent mechanism for savings that members can't access. And the reality is that when retirement fund members change jobs, they access their retirement fund pot. There are people that are in dire economic situations that will resign from an employer despite our crazy unemployment rate to access that retirement pot. So people are accessing that money. So we're finding that they're not holding on to those accumulated benefits till they get to retirement. So the two-pot system is an attempt to try and address that critical shortcoming. And if you've got a more permanent capital vehicle, you can take longer-term views in terms of your investment. You can invest in more illiquid infrastructure, which we need. So there is a good rationale for why you want to have a two-pot system in place. In the shorter term, there is a risk. So you can access 30,000, a maximum of 30,000 or 10% of your accumulated benefits from the 1st of September. There's a lot of questions about how that's going to work. And I think there's a lot of unintended consequences and a lack of understanding of what's going to happen. One of the biggest one of those is that you're going to be taxed at your marginal tax rate.
Yep.
So, you're not going to get that 30,000, you're going to get less. So I think that we are heading for a situation where there's going to be a lot of disappointment in the system. And I do think that Labour sees this as phase one of a longer term plan. They always have wanted to access more of the retirement fund pot. And I think it's going to be a very contested space into the future. Once we get through the implementation of the two-pot system and the access has happened on that initial pot, I think there's a fairly good chance that there'll be contestation around how you can access more of the residual pot.
Thanks, Mike. So as we almost head towards some questions, I need a quick answer. So both of you have got 2 minutes on the following. Mike, you rated the budget at 5.5. The finance minister is looking at you and he is saying, how do I get it to a 7.5? I need you, if he is watching right now, tell him what does he need to do to get it to 7 or 7.5. You are further away from Sanisha, and so maybe he doesn't need to do too much according to Sanisha, but just give us a quick view on that, please.
So I think on a 1 year basis, on a 5 year basis, you don't get the budget from a 5.5 to 7.5. So it has to be an incremental approach, 5.5, maybe 6, and so forth. And ultimately what the minister needs to do is he needs to prioritize capital expenditure. At the moment, there's a priority of social expenditure. It's a critical need in the country because of the hardship that people are going through. So it's a very difficult balancing act. So over time, you need to start diverting some of the social expenditure to capital expenditure. Politically very difficult, the diversion, or you need growth. And from the incremental growth to start allocating to capital expenditure. That's how you improve the budget, but it's not a 1 year story.
Thanks, Mike. Sanisha, you've got not as much to do as Mike, but how do we move from your 6.5?
So, I think we always talk about the plans are good, but the implementation and the execution of the plan doesn't always follow through. So I'm going to steal an anecdote that I heard from one of the former heads of the budget office, Michael Sachs, when he spoke about the social compact. So you have government, business, labor, civil society all in the same room. And each of these bodies is carrying an egg. And everyone wants an omelette, but no one wants to crack their egg. And so I think it's going to be a bit of give and take. I think that's really where we are in terms of how to resolve for the trust deficit. And so, for example, government really coming to the party and saying that we do need private sector on board, but then making it more attractive for private sector to come on board. So, as an example with Transnet, why we didn't get so much of take up from the private sector participants was we couldn't have, all the railway networks being allowed to be on a concessionary basis, or the timelines that these private sector could operate wasn't long enough to match the duration of the assets. So this became less and less attractive for the private sector. So I think ultimately it is about the social compact and bridging that trust deficit in order to get from the planning stage into the execution stage.
Thank you, Sanisha. So as we move from eggs to omelettes to rabbits, we now head to a few questions. The first question, Anva, thanks for asking. To meet that kind of debt on a daily basis, what is the gross income projected to cover that debt?
In other words, where your revenues need to be pitched. So
who is brave enough to take a stab at that one?
It depends on where you want your ultimate debt ratio to stabilize at, right? So we know that the International Monetary Fund, as an example, says that 60% is kind of a good benchmark because at that point, whatever you pay on your debt servicing costs doesn't really crowd out other forms of more useful expenditure. But given that our expenditure demands are quite high going into the medium term, it does, as we previously stated, I think there will be some sort of bigger increase in taxes coming down the line, something like an increase in the value-added tax rate in order to cater for those larger expenditure needs. So unfortunately, we can't only look at where debt is today and where expenditure demand is today, because further down the line, in a slow growing economy, we're going to see a further rise in social demands. And that means that we need to have permanent revenue streams to match that.
Thanks, Sanisha. The next question. The budget speech has happened and the measure has been announced. If you could improve on the existing budget announced, which 3 improvements would you have announced, and what 3 measures announced would you have dropped? Asked by Robert.
So I think there should have been more on infrastructure investment. So
you would have liked to have seen more on infrastructure, which was barely touched on.
And the rate of investment in infrastructure has decreased. So, you're solving capital expenditure for social and immediate expenditure. So that would be the first one. The second one, the utilization of JFECRA. So I agree with Sanisha, to put it in general expenses to solve the wage bill overrun. You're just kicking the can down the road, maybe for 3 years. What happens when the money runs out, and what happens in 2 more years? You've got to have another round of wage talks, and you haven't permanently solved the problem. Whereas if you had made that money a little bit more capital orientated, a little bit more part of the productive economy, it would have had a better outcome.
So more robust discussions and more involvement in terms of JFECRA.
Yeah,
which we've seen was lacking.
Exactly. What are we going to spend the money for? It's not going to be a general expense. And then, so those are the big ones for me.
I'll give a nice third one.
Yeah.
For a number of years now, government has been talking about implementing some sort of fiscal anchor. Because I think that gives the market a lot of confidence that government will adhere to its fiscal prudence plans. And despite all of that, build up to announcing some sort of fiscal anchor, it was a bit of a disappointment in that we didn't get a permanent fiscal anchor. They basically said that we're going to have the debt stabilization primary surplus being an anchor for the medium term. But I think something like some sort of anchor put in place on a more permanent basis would give us a bit of a boost on a ratings perspective, a bit of confidence in government's ability
which
to
we
keep
need
us on that path.
Some confidence.
And a lot of the things that that wasn't spoken about, there's a lot of uncertainty. What happens with NHI? What happens with retirement fund reform? We almost want a Rolls-Royce outcome with Toyota money. Government needs to start saying some of these things are unimplementable, and this is what we want to back, and this is what we can't back. So I think if there's a little bit more clarity in terms of, we can't do everything, rather than just avoid talking about something or put notional amounts into projects so that we can say we're still looking at them, just take the view and say, this is something that for the next decade is off the table, or we're never going to get there. This is where we want to put our spending priorities, because clearly there's not enough money to go around.
Thank you. Next question. How does JFECRA translate into actual cash flow by not actually selling reserves? Are these not only unrealized forex adjustment? Jock, question by Jock.
So the mechanism that JFECRA works with is essentially between the Reserve Bank and National Treasury. So we spoke about the 150 billion, which is really the allocation to bring down the debt ratio in the next 3 years. There's also a 100 billion allocation that goes to the Reserve Bank's contingency reserve account. And that's what we have as the sterilization fund. So effectively, it does become monetized. And when you monetize something, it can have an inflationary impact on the economy. And that means that someone then has to sterilize those funds. And so there is a cost attached to it. And that's really where the other 100 billion comes into play. And that's collectively, we get to that buffer of the 256 that's left in JFECRA, which is then there in order to facilitate any positive currency movements, but adverse for the JFECRA account.
But look, I think what is important and what it really speaks to is almost, this mechanism is, the inner workings of it. There seems still to be a lot of uncertainty as to how it works. And you've made those points, through this discussion today. Another question by Jock. Will the large multinational corporation tax really add 8 billion rand in tax, or only drive further and expedited disinvestment?
So the comment I'd make, if it was a standalone basis, if it was South Africa that independently wanted to add an additional corporate tax on multinationals, that's exactly what would happen. But this is an OECD-driven initiative to try and stamp out tax and transfer pricing. So it is a global initiative. So I think on that basis, it's less harmful or less discouraging for foreign investors. But if it was a new tax and it was a South Africa-specific tax, yes, that would have been a bad outcome. And that was what I was saying. It was a very cautious tax approach.
Thank you, Mike. The next question by Ryu Stevens is one that I asked myself, actually, and it's all about the silver lining. Is there anything we as South Africans can be positive about now that everything is seemingly in ruins? And I think that is, a good question. There is a lot to be negative about, but please try, and highlight some of the positives from the budget.
So I think there's probably a couple in the audience that believe in the 5.5 rating more than the 6.5 rating from that question.
It seems that way.
But I mean, it's that question comes from subdued consumer and business confidence in South Africa, where we are languishing at, long-term, relative to the long-term average. We've seen business confidence in the doldrums. We've seen consumers' confidence really struggling to get back to that longer-term average level. So I can see where that question comes from. And I'll take us back to a point that Mike raised earlier in terms of where we are seeing some of the silver linings on what used to be extremely big obstacles to growth, which is at the moment the biggest obstacles to growth are effectively energy and logistics. And at least on the energy side, we're starting to see quite a significant pipeline of renewable energy projects. Part of that has been driven by easier legislation that has been put in place by government to allow the private sector to come in. It was also spoken about in the budget that now that we're sort of sorting out the generation part, we're also starting to now focus on transmission, which is the next big issue in the energy space. And they are looking at financing vehicles to bring the private sector in order to participate in growing our transmission network, in order to facilitate more electricity production in South Africa. On the transport and logistics side, we have had the freight logistics roadmap, which is essentially a path to resolving for the logistics crisis in South Africa, very similar to when we had the National Energy Crisis Committee. So we have something very similar, a very similar model with the very similar work streams being brought into place into the transport sector. And then again, we spoke a little bit about, the private sector involvement at one of the ports as an example, the fact that by May, the legislation will be put in place to allow for the private sector to start operating some of the rail network themselves. So we are starting to see some movement. It's my belief that, for us to generate higher levels of economic growth, it is going to be led by more and more private sector participation, whether government likes it or not.
And so in time, the public-private partnership will need to move closer together, and the way in which we do it is by almost more lenient, rules of engagement between the
and there's a lot of space for that to grow. If you look at private-public partnerships in the infrastructure space, that actually makes up less than 5% of total infrastructure. So we have a long way to go, and there's a lot of opportunities. They just need to be lucrative enough for the private sector to get involved.
How I'd answer that question is some of the stuff that wasn't said in the budget or didn't happen in the budget. So in an election year, it wasn't a populist budget. So the temptation and the pressure from a political perspective,
which you have to admire.
So there was real fiscal prudence is the first thing. I've described the budget as kicking the can down the road and treading the water, but there's a good reason for that. So if we look a couple of years into the future, the expectation is that interest rates or inflation and interest rates will come down. So in theory, the debt servicing cost should come down. This was a fixed interest investment popular budget in terms of the primary fiscal surplus, in terms of potential sovereign debt. So that might also bring more capital into the country, which would enhance growth prospects. So government is clearly sort of the unwritten assumptions here, expectations around compression of the sovereign credit risk spread, interest rates being lower, better revenue collection into the future. And the other big one, and I'm seeing a lot of pressure about it if you look at how Treasury is treating municipalities at the moment, is expenditure control.
Yes.
So what's happening now is when budget amounts are allocated and they're not being spent, it's like use it or lose it. Treasury is taking that back. So we've heard in Pretoria, Tshwane, there was a big hoo-ha about money being pulled back. I saw an article this morning, the same thing happening at Nelson Mandela Bay. Sanisha, if you read her note, she'll talk about the 10 million grants, but only 7.5 million of them get paid because they're on bank accounts. So those are mechanisms. Treasury is looking for ways to control expenditure. I mean, it creates a lot of pain, you know, sub-inflation
But
increases.
responsible.
It's responsible and
Yes.
it's realistic. So I think
Thank you,
that's the
Mike.
silver linings.
Next question. The minister projected growth to average 1.6% between 2024 and 2026, which will not be enough to cater for expenditure of the country. What can we expect to be done to improve growth in order to attract investments?
I think I
Questions from
answered
Marcela.
that a little bit in the
Yes, you
previous
did
one.
touch on it.
Yeah.
Maybe I'll add a little bit to that. So there is something called Operation Vulindlela, which is a project office that sits within the presidency. And they've got 5 work streams that work on energy, on the transport logistics side, visa spectrum, water, and then the broadband spectrum. And we're currently well into the 5-year of project of Operation Vulindlela. They've actually completed or are on their way to complete this year about 70% of the reforms in those 5 work streams. Now, if we get to the 100% sort of completion rate on that, they estimate that can, boost growth to around 3 to 3.5%. So that gives you a bit of an order of magnitude that if we, do tick the boxes on the structural reform efforts and we do reduce the red tape, we can kickstart growth to a higher level.
Thank you, Sanisha. Our next question comes from Krishna. If they have been increasing sin taxes, and let's be honest, we don't touch on sin taxes, but if you like to have a glass of wine and you like to smoke, I mean, those are always going to increase, and this time around was no different. So let's quickly get back to the question, but if they've been increasing sin taxes, fuel levy, and VAT in the past in a percentage, shouldn't there be more than enough money in the budget in the following years to come? Interesting question.
There is, but unfortunately, we're also at a point where there's growing expenditure. So, think about the public sector wage bill and how some of the labor unions go in with, 15 to 20% demands, and, they settle somewhere under 10%. But that's just one example. We've got the additional funding stream now for the social relief of distress grant, which, by all lobbyist groups looks like it's going to become a permanent expenditure stream. We've got other additional demands in terms of social security reforms, the national health insurance. And so it really is, talking about how fast is expenditure growing relative to that growth in revenue. And that's essentially what causes your budget deficit to widen and your debt ratio to continuously tick higher.
Next question. Next question is from Mark. Mark, your use of the English language is admirable. I'll try my very best. Are the authorities aptly competent for such erudite pecuniary planning with insight, hindsight, and rare wisdom? Sanisha, I'm going to throw that one to you.
Or should I jump in there?
So, I mean, at a very high level, and I can chip in, I think this question is really just asking more about how we've actually made do with what we have available in the budget. And I think that if you look at the quality of the national treasury candidates that are there, there have been a lot of, I guess, concerns in the past that many of the people from National Treasury have been moving to other institutions. But I think we've got a very good set of people there that look at the budget numbers. The budget process, what we see on budget day is planning for weeks and months before that. And so, I think we are still at a point where we've got a highly transparent budget process that we can still be quite proud of relative to international comparisons. We do actually rank quite high on that. So I give it my full confidence there.
So I'd say we've got excellence in pockets. So National Treasury is good. The receivable revenue is good. But there is a competence challenge in government. So in the broad sense, is there sufficient competence to execute? And we've seen a massive execution problem on some good policies. That's where it falls down. In terms of the central thinking and the central control, there's good thinking there. There's good people there. But I mean, it's a very nuanced question.
Thank you. As we probably head into some of the last questions, our next question says, thank you for a very informative presentation. Thank you very much for your attendance, and thanks for the compliment. What are your views in terms of current BEE legislation and the impact of BEE on foreign investment and potential foreign investment investors?
So I don't think that SA should be viewed in isolation here. So I think we need to look at ourselves versus other African nations as an example. One of the comments that once came from the Chamber of India, they said, they look at various investments across the African continent, and BEE regulations are not the only thing that would put them off. What really does put them off wanting to invest further in a country like South Africa is a high level of policy direction and policy certainty. And that also comes out when we look at the Bureau of Economic Research's survey that they conduct with manufacturers, where over 80% of manufacturers say that they don't want to invest in South Africa, not because there's not enough demand or not enough skills, but because there's this high level of economic and policy uncertainty that they have to cater for. And I think that's then one of the biggest hindrances to fostering high levels of investment.
Thanks, Sanisha. That is the end of the question and answer session. For those of you who might have more questions or might need more in-depth information on the budget, please be on the lookout for Sanisha's note. I'm sure it will be attached on the presentation. For those of you who have stayed, thank you very much. For those people interested in CPD points, please do know that we have applied for CPD points. I would like to maybe finish off and give each and every one of you maybe just a minute to land something with the crowd. But thank you for both of your attendance, for your insight, and for your expertise.
Well, Francois, maybe I'll just sort of wind it up by saying that, I think it was one of the points you said initially, that we can't look at the budget in isolation. We do have to look at it in conjunction with what's happening in the economy. And I'd add to that, we can't only look at what's happening in the local economy, we are still operating in a global context. We're in an environment of slowing economic growth globally, where growth is moderating. It's a politically fraught backdrop with, the highest number of elections this year than we've seen in many, many decades. And that's kind of the backdrop that we are operating in. So this has been, very challenging economic times to table the budget. And I think ultimately that's why I gave it, sort of the 6.5 rating, because we do have to look at the fiscal realities better down in the economic and political realities in SA.
Thanks, Sanisha.
Thanks, Francois.
Mike, are you going to leave us with something positive? Your 5.5 didn't inspire any confidence.
It was a pass mark. So, I mean, that's the first point. So it wasn't a bad budget. It wasn't a great budget, and I think
safe. Is that safe to say?
It was an okay budget, and it wasn't. But I'd say it was a realistic budget. So could we have a great budget? No. I think in the current economic context, we can't have a great budget, and it's local, global, it's revenue, a lot of things. I think it was a decent budget. It resisted some of the populist urges, which I think were quite worried about. So yeah, it was a passing budget. Would we like to see more of these budgets? If we get more of these budgets, we're on a downward trajectory, but the can's been kicked down the road for a reason. And if we do get lower interest rates, if we get the sovereign credit spread tightening, we could be in a better situation. The key for us is ultimately growth. So growth solves all problems. The level of growth that we need to solve the problem is not where we'd want it to be. So it's going to be very difficult to get very high levels of growth. So it's going to be a slow grind out of the current situation. This budget didn't make anything worse. So that's what I'd say. It was a passing grade, and I'm comfy with it.
Thank you for your positiveness, Mike. To each and everyone who attended today's session, thank you for your time. Until next time.